Welcome to Tesla Daily News Podcast. It's Tuesday, January 27th, 2026. Today, we're digging into one big theme investors can't ignore. Tesla is leaning harder into software monetization and autonomy, while competition and regulatory risk keep rising. We'll cover the end of free Autopilot in North America, what a cheaper FSD price could mean for margins, a fresh Cybercab production timeline, Tesla's AI compute roadmap, the Optimus factory training push, and a few key market and competitive signals that could move Tesla sentiment this week. Story 1. Tesla just removed free Autopilot from new cars in North America, and that's a major shift in how Tesla wants to make money. Context. For years, Tesla used standard driver assistance as a must-have baseline feature, a strong value prop that helped justify pricing and supported brand leadership in EV tech. Now, Tesla is explicitly trying to convert more owners into paid software. Details. Multiple reports say new Model 3 and Model Y sales in the US and Canada no longer include the traditional Autopilot lane keeping and auto steer features as standard. Instead, buyers are left with traffic-aware cruise control as the base layer, and they must pay for full self-driving or a higher software tier to get lane centering and automatic steering back. Impact. For investors, this is a classic trade-off. If Tesla can successfully push attach rates higher, it boosts high-margin recurring revenue, the kind of revenue Wall Street tends to reward with higher multiples. But if consumers feel like features were taken away, it could pressure demand, increase price sensitivity, and push buyers toward competitors offering similar driver assist features as standard. Near term, analysts will watch order conversion rates and any signs Tesla has to offset this with price cuts or incentives. Takeaway. This is Tesla betting that software can carry more of the profit load, but it raises execution risk on demand and customer satisfaction. Story 2. Tesla is also cutting the monthly price of FSD in some reports, and the pricing strategy matters as much as the technology. Context. Tesla has long positioned FSD as a premium option. The company's challenge is getting enough subscribers to make software revenue meaningful relative to auto gross profit. Details. One report points to an FSD subscription price drop to approximately $49 per month in connection with the Autopilot removal, while other coverage emphasizes the strategy of pushing more customers into paid FSD. Separately, at least one outlet references a price point around $99 per month, highlighting that pricing may differ by market, eligibility, or promo structure. Impact. Lower pricing can be bullish if it drives a big jump in adoption. Think of it like streaming. A lower monthly fee can still produce more total revenue if the subscriber base expands enough, and the gross margin can remain very high because software delivery costs are relatively low. But price cuts can also signal weaker demand for the product at prior price points, and investors may worry that Tesla is training customers to wait for promotions. Takeaway. The key investor question isn't just what is the FSD price, it's what is the net FSD take rate and churn, because that determines whether this becomes a durable recurring revenue engine. Story 3. Cybercab appears to be moving from concept to production timeline, with winter testing underway and a claimed start of series production in April. Context. Robotaxi is one of the biggest valuation swing factors for Tesla. If Tesla can scale a dedicated autonomous vehicle and deploy it at meaningful volume, it changes the earnings narrative from cyclical auto sales to platform economics. Details. Reports say Tesla prototypes are being winter tested in Alaska in snow and ice conditions, and Elon Musk has stated that Cybercab series production is expected to start in April. The coverage also reiterates Tesla's approach, heavy reliance on Tesla Vision, meaning camera-based perception, rather than a sensor stack built around LiDAR. Impact. Investors should treat timelines cautiously because robotaxi schedules have historically slipped across the industry. Still, the market will react to credible signals of manufacturing readiness, supplier activity, tooling, pilot lines, and regulatory progress. If April production is real and ramps, it creates a narrative catalyst ahead of mid-year, but the revenue impact depends on whether Cybercab is sold to customers, operated by Tesla, or deployed via partners. Takeaway. Cybercab is back on the near-term calendar. Watch for tangible proof of a production ramp, not just prototype footage. Story 4. Tesla is reportedly re-accelerating its internal AI and compute roadmap, including Dojo 3 and new in-car AI chips, to reduce dependency and improve autonomy performance. Context. Autonomy at scale requires massive training compute, fast iteration, and tight integration between software and hardware. Tesla's investment case often hinges on the idea that it can do this better and cheaper than rivals. Details. Coverage points to Tesla reviving work on Dojo 3, alongside progress on an AI 5 chip, which would support more advanced onboard processing. The strategic logic is straightforward. Train better models faster, deploy them more efficiently, and keep more of the stack in-house. Impact. This is a long-duration bet. Ramping AI compute is capital-intensive, and investors will want to see it translate into better FSD capability, higher subscription adoption, and eventually regulatory approvals. If it works, it can support a higher valuation multiple by reinforcing Tesla as an AI and robotics company, not just an automaker. Takeaway. Tesla is doubling down on vertical integration in AI. The payoff is big, but it's not immediate, and it needs measurable milestones. Story 5. Optimus is shifting from lab demo to factory training in Texas, with data collection planned to start in February. Context. Humanoid robotics is a high-upside narrative for Tesla, but also one of the most speculative parts of the story. Investors need signs of real-world task learning, reliability, and unit economics. Details. Reports say Tesla plans to train Optimus at its Austin, Texas factory, starting data collection in February to teach the robot factory operations. This suggests Tesla wants real production floor data, not just staged environments. Impact. In the near term, this won't move revenue much, but it can move sentiment. If Tesla demonstrates repeatable factory usefulness, even for narrow tasks, it supports the idea that Tesla's AI stack can generalize beyond driving. That can matter for the long-term valuation framework, especially for investors who view Tesla as an AI platform. Takeaway. Watch for measurable factory productivity use cases, hours worked, tasks completed, error rates, and any hints of internal deployment scale. Story 6. Competition and market share pressures in key regions remain a headline risk, especially Europe. Context. Tesla's auto business still funds everything else. Even if software is the future, deliveries, pricing, and margins are the present. Details. Multiple sources point to Volkswagen overtaking Tesla in European EV sales during 2025, and broader coverage across the industry suggests a more competitive, affordability-constrained market in 2026. At the same time, competitors are still working through software challenges, like reported integration delays in the Volkswagen and Rivian partnership. Impact. For Tesla, the takeaway is mixed. Losing top-of-table positioning in Europe can pressure brand momentum and pricing power. But if rivals struggle with software execution, Tesla can still differentiate on user experience, charging integration, and over-the-air iteration. Investors will watch whether Tesla responds with product refreshes, pricing moves, or localized manufacturing advantages from Berlin. Takeaway. The competitive set is stronger, but many are still behind Tesla on software iteration speed. Demand and pricing will decide who wins the next phase. Story 7. This is a big macro and earnings week, and it matters for TSLA's near-term trading. Context. Tesla trades like a high-beta mega-cap tech stock. Macro expectations, rates, and the tone around AI winners and losers can move Tesla even when company news is quiet. Details. Multiple market previews highlight the Federal Reserve meeting and major tech earnings this week, including Tesla. Impact. If rates or guidance sentiment shifts risk appetite, Tesla can swing hard. In the earnings setup, investors will be watching automotive gross margin trajectory, any commentary on demand after feature changes, progress on autonomy timelines, and capital allocation toward AI compute and robotics. Takeaway. Tesla-specific catalysts are colliding with macro catalysts. Expect volatility. That's the rundown for Tuesday, January 27th. The big themes today. Tesla is pushing harder to monetize software by removing free Autopilot. Cybercab is being pulled into a nearer-term production narrative. And Tesla's AI and robotics investments are getting more concrete with Dojo and Optimus factory training. For tomorrow, watch for any new details on Tesla's earnings timing, analyst note revisions tied to the Autopilot change, and any additional confirmation of Cybercab manufacturing milestones. If you found this useful, subscribe to Tesla Daily News Podcast and follow for daily updates that focus on what actually moves the stock and the business. See you tomorrow.